Welcome to today's Explainer. We are jumping right into a measured, institutional look at the macroeconomic data currently driving this massive AI infrastructure boom. We're going to deeply analyze NVIDIA's shifting market dominance, look at how the realities of supply and demand are completely reshaping pricing models, and finally, assess whether this incredible cycle of capital expenditure is actually sustainable in the long run. Let's get right into the data. To really set the financial context for us today, we have to start with one defining metric, 101%. In just the first half of the year, the SOX Semiconductor Index posted a 101% gain. To put that into perspective, that includes an 88% surge in the second quarter alone, which, by the way, easily shatters records we saw back during the dot-com bubble of 2000. So this is the financial reality we're operating in right now. We're seeing a truly historic concentration of capital flowing directly into the foundational hardware of the AI era. Here is the structural breakdown of our analysis today. Number 1, the H1 semiconductor boom. 2, NVIDIA's shifting market share. 3, the custom silicon threat. 4, AI compute supply dynamics. And 5, AI CapEx sustainability.
Part 1, the H1 semiconductor boom.
Right now, we are looking at an absolutely unprecedented divergence in global equity markets. Think about this. While the semiconductor SOX index soared that 101% and the broader NASDAQ 100 gained a solid 28%, the average performance of the Magnificent 7 megacap tech stocks actually dropped by about 8% during that exact same period. What does this tell us? Well, it tells us we are witnessing a massive structural capital concentration in hardware. Investment funds are actively pivoting away from the software spenders who are currently facing some intense valuation recalibrations, and they are moving aggressively toward the chip makers who are pulling in massive immediate revenue.
Part 2, NVIDIA's shifting market share.
When you're sitting at the absolute top of the market, every tiny shift is scrutinized heavily. And that brings us to a really prominent bear case narrative that's emerged recently. Short-term sentiment has definitely been swayed by reports suggesting NVIDIA's dominant market share has slipped from a historical peak of 87% down to roughly 75%. And naturally, a drop like that fuels a ton of speculation that major clients are finally, successfully, finding workarounds and exploring alternatives to NVIDIA's hardware.
The underlying thesis here is what industry analysts are calling the de-NVIDIA movement. The idea is that major cloud providers, the hyperscalers like Google, Amazon, Meta, and Microsoft, are actively trying to reduce their deep reliance on NVIDIA. They want to pivot toward their own in-house silicon, decouple themselves from NVIDIA's incredibly protective CUDA software ecosystem, and expand cross-platform frameworks. In fact, some of these bear reports are highlighting how AI powerhouses like Anthropic are actively using Google's TPU for training and Amazon's Trainium for inference. They're essentially attempting to relegate NVIDIA to the role of a backup system.
Part 3, the custom silicon threat.
So we really need to critically compare NVIDIA's hardware with this incoming competition. On one hand, you have NVIDIA's highly flexible general-purpose GPUs. On the other, you have custom ASICs, that stands for application-specific integrated circuits, things like Google's TPU or Amazon's Trainium, which hyperscalers are deploying more and more. Now, ASICs are fantastic. They are incredibly cost-effective for specific repetitive tasks. But as we all know, AI is anything but a static field right now.
This distinction becomes absolutely paramount when we talk about frontier pre-training. If you're not familiar, this is the initial, computationally massive phase of developing the world's most advanced large language models. And in this specific phase, algorithm architectures are literally changing on a daily basis. Because of that rapid, chaotic evolution, custom silicon, those ASICs we just talked about, they are simply far too rigid. They physically cannot adapt fast enough to the bleeding-edge demands of frontier research.
Because of that need for extreme adaptability, the hard reality is that NVIDIA retains an absolute monopoly in frontier pre-training. It's just a fact. Any company attempting to build the next generation of LLMs literally cannot survive without NVIDIA's top-tier clusters. So while competitors might be successfully chipping away at the edges in the inference market, NVIDIA maintains total dominance and, by extension, immense pricing power in the highest margin, most technologically demanding segment of the entire industry. The pie's growing so incredibly fast that even if NVIDIA takes a slightly smaller slice, it still equals exponentially more revenue.
Part 4, AI compute supply dynamics.
Now let's talk about how the supply-demand dynamic and these subsequent pricing models are being dictated today. Because right now, it's not dictated by a lack of orders. It's heavily dictated by physical bottlenecks. We have exponential compute demand slamming right into extreme pressure on advanced packaging capacities, specifically TSMC's packaging lines. This isn't just a software issue we can code our way out of. This is the very real physical limit of trying to fit billions of transistors onto a highly constrained surface area. And it is actively forcing hardware design recalibrations across the entire industry.
And the real-world impact of these physical bottlenecks is already highly visible. Recent industry reports show that NVIDIA was actually forced to scale back its highly anticipated next-generation Rubin Ultra. They had to pivot from a planned 4-chip design down to a 2-chip design. The root cause? TSMC's CoWoS-L packaging actually experienced warp defects at that larger size. Think about the implications there. If the absolute industry leader is colliding with hard physical limits, competitors who are attempting to achieve similar compute densities are going to face even steeper barriers. This dynamic ultimately just further cements NVIDIA's lead.
Part 5. AI CapEx Sustainability.
The current capital expenditure reality is incredibly complex. Hyperscalers are currently issuing massive amounts of corporate debt to fund these sprawling infrastructure builds. And because of that, markets are systematically recalibrating their valuations, asking the obvious question: exactly when will these vast capital expenditures actually yield tangible returns? But here's the thing, it's not just corporations driving this anymore. We are now seeing sovereign AI infrastructure projects spinning up on a global scale. Japan, for instance, recently announced a staggering 370 trillion yen investment plan targeting AI and semiconductor independence. South Korea is deploying similar massive national-level capital. It's an arms race.
To really capture the reality of this unquantifiable demand cycle, there's a grounded metaphor that I think hits the nail on the head. Trying to calculate this right now is literally like asking an architect for the final cost of a massive skyscraper while the foundation is still actively being expanded. The market is trying desperately, and honestly prematurely, to call the absolute peak of AI demand. But the reality is, global capital is still actively being allocated and tallied.
The underlying truth here, especially when you step back and look at the institutional data, is that global capital expenditure across data centers, advanced packaging, power grids, and cooling systems, it is all still compounding. Nations are aggressively securing resources, massive enterprises are fighting tooth and nail for compute, and capital is chasing efficiency everywhere it can. Any attempt to definitively quantify the ceiling of this investment cycle right now is just premature. The story is quite literally still being written.
So, as we wrap up today's explainer, this is the definitive question we want to leave you chewing on. Have we actually underestimated the infrastructure era? Yes, the fundamental rules of market cycles haven't changed, but the sheer scale of this transition to an AI-driven global economy might just be far larger than any of our current models predict. Thank you so much for joining me for today's explainer. Stay focused on the data, and we will see you next time.